Hello again, everyone. It's a great pleasure to introduce the next group of speakers for our next session, Investing in Financial Services, VCs and Startups Talk Funding. Our speakers will discuss killer apps, essential strategies, product and personnel criteria, and the evolving landscape in VCs and startups. Let's welcome our moderator, Veronica Glab, Head of Partnerships and Investment Lead at Innovate Finance, who will introduce her panelists. Veronica, the floor is yours.
All right, thank you. Hi, everyone. So I'm Veronica Glab, Head of Partnerships and Investment Lead at Innovate Finance. We're the membership and advocacy body for Fintech coming in and out of the UK with our headquarters in London and an office in New York. So basically what I do is I head up our annual investment report, which tracks all the macro trends and all venture activity into fintech around the world. And from that, on the backbone of that, I lead our partnerships program to connect early stage and growth stage fintechs to VCs and larger investment funds. So I'm very pleased to introduce our panel today to talk about killer apps and the direction of travel for financial and fintech innovation. But I will let you guys introduce yourselves. Guy, can we start with you?
Hello, my name's Guy Hopkins. I'm the CEO and founder of FairXchange. We are an FX data analytics platform.
Hi, Christian Frahm. I'm the CEO and founder of United Fintech. We provide a digital transformation platform for large banks and large institutions. Invest quite heavily into the fintech space.
Ingmar.
Hello, Ingmar Mattus. So I'm co-founder of Tickmill Group, and I'm also the founder of Andromeda Capital Partners, which invests into various fintechs in our space. Thank you.
Hello, I'm Andrew Murray. I head up institutional strategic investments for Citi. So I manage a portfolio of fintech, startup, and market infrastructure investments that are strategically relevant to our institutional businesses.
Right. All right, thank you guys. So moving on to our topic of the day. So as funding becomes more and more competitive in 2023, founders need to work hard and deliver fast to capture investors' attention. The rules of the game have fundamentally changed, and the world of tech has moved away from a growth at all costs model as macroeconomic and geopolitical shifts, not to mention the headlines around OpenAI and other high-growth startups over the weekend, have brought tech to a turning point. So, how do founders capture the imagination and, more importantly, the vested interest of investors? And are there any different rules for startups and SMEs in the financial services space? All right, so I'll kick off with my first question, and I'd like to survey the landscape, so I'll open this up to everyone. So beyond the broad kind of brushstrokes of decreasing investments, what are you seeing today, and what do you foresee in the next couple of months in terms of risk appetite by investors, the level of startup activity in financial services, or any sort of consolidation or expansion? Guy, I'll kick off with you, but it's open to everyone.
Well, we're lucky in lots of ways, and we're quite fortunate in that we've actually had an investor for the last couple of years, actually United Fintech. So United Fintech is an investor in FairXchange. And from everything I'm hearing about the funding landscape at the moment, I'm very, very thankful that 2 years ago we did the deal with United Fintech, because we are now able to focus on engineering and on growth, and we don't have to worry about funding at the moment, because I understand that the funding landscape is substantially different to how it was just 2 years ago when we took the investment from Christian and the team. So yes, obviously there has been substantial change recently. Mercifully, we are kind of shielded from that.
And Christian, do you actually want to add into that growth story as well? Because you're coming in from the other side of the conversation.
Yeah, sure. I think in general the macro story is the same. So we see a space. I mean, people been calling out fintech like they called out the internet when that was early in its infancy. And for me, like the core story is the same. It's a very compelling story into fintech. We see banks, big institutions need to digitize, need to change the infrastructure. So the investment space right now is very difficult, but you have macro trends going in the right direction. So I think it's probably the most difficult space in the past 15 years to actually raise money in. And we see a lot of course, interest for money. But you know, I was in Singapore last week, also with Andrew actually, and lots of discussions about difficult environment and people saying this is the most difficult environment next 15 years. And I don't think it's changing rapidly, unfortunately.
Okay. Well, for better or worse, Ingmar, Andrew, would you want to weigh in on that one?
I mean, I talk with startups on a weekly, daily basis, and I think one of the key terms that you could use in terms of describing the environment is just one word: runway. So that's the focus of every startup out there. So you have to have the runway as long as possible. So and the firms where we have invested, so the runway is 2 up to 3 years. So you can really focus on building your products and pushing them out there to the market. So in that relation, I think it's really detrimental to have your costs really as low as possible and focus on efficiencies across the board, really.
Yeah, I'd second the point around increased focus on resiliency of the business model and cash burn, and the tolerance for the high growth, high burn models greatly reduced. But I think there are some positives in that, like, a lot of the headline numbers have been driven by some of the later stage activity. So where we look at the big year-on-year declines, that's driven by a lot of the mega rounds of above 100 million. If you actually look at the number of transactions that are still going on, we're not that far below the pre-COVID period. So it looks a lot year-on-year, but particularly at some of the earlier stage, it's not all completely doom and gloom. And certainly from our perspective, as a strategic investor, by number of transactions, we're doing more than last year. Like, our strategic priorities haven't changed. The needs of our business in terms of their innovation priorities haven't changed. And as I think we'll hear later on, there's a lot still to fix in capital markets infrastructure. So we're still a buyer for these types of things. So the customer base is out there. I think that there has been a flight to quality. So we're seeing a little bit more competition at the higher quality, like good business model, robust, proven customer base. And then there's less tolerance for the higher risk business models. So I think it's that sort of barbell effect that we're seeing.
So actually, Andrew, you make a really good point, is that investment levels, while they have dropped in the past year, are still higher than they were at 2013. The difference perhaps being the quantity and quality of the fintechs that are out there in the market. So for this question, I actually want to direct that to yourself as well as to Ingmar to weigh in. When you're assessing the potential acquisition or investment opportunities, what does a winner look like for you if you're looking at founders as individuals or business leaders? And then conversely, is there anything that would absolutely put you off? Is there any sort of phrase that a founder should avoid using in their pitch deck?
I'm happy to go first. So I think on the positive side, certainly when we're looking at capital markets infrastructure, it's quite complex to get all the things lined up, from having a product and the technology underneath, the distribution, the customer adoption, what problem you're solving, who is it for, how much are they going to pay for it, how do they onboard, how do you adopt, particularly if you need a network there. So someone who really thinks holistically and is not just, oh, I've got a good widget here and it must be the best thing on sliced bread, has really looked across that and has the forethought to build up a team with the right capabilities. So that it's very rare that one person can do everything. So you need someone who is the product expert who can speak to the business, someone who's a tech expert, someone who has some preferably startup scaling experience and knows what it is to walk into an empty building day one and start your office. And that's where we've seen, like, a lot of people who have good ideas but haven't thought through all of the different complications. I think the other part, and this goes between positive and negative, is, I mean, integrity is a must. Where we're investing and, more importantly, giving a counterparty our franchise, we need to be able to trust them. And we've heard enough fintech pitches that we're quite good at. We have quite a good BS detector. And through the life of the relationship, we need this to be a long-term partner. So I think that, and someone who will recognize that there are challenges and they can meet them head on and address them, rather than always just focusing on the upside case. And this goes to the point around runway as well. Like, from an investing standpoint, but particularly from a commercial standpoint, we've got low tolerance for surprises. And we've had examples of companies where, for example, they've got 4 months of runway, 4 weeks of runway left, and the founder goes on holiday for his annual jobby down to Spain. That doesn't go down well, especially if we have critical reliance. So it's that sort of where we're investing. We need trust in that partner. We need their credibility that they can deliver themselves and the team. And I think the final one, yeah, we're used to a lot of the buzzwords. So if it's not necessarily a positive if you claim to be a quantum, Gen AI powered blockchain ESG solution, or claiming you're going to revolutionize the world, because there aren't many things that have been truly revolutionary, and often that's not what we want. We just want something that fixes a particular problem for a particular person.
Ingmar, Christian, do you want to weigh in on that as well? What are your red flags or green flags?
I mean, I really like founders who are like visionaries and who are, let's say, passionate about what they do, and they definitely must have an experience in the area where they are operating, and track record for sure as well, and for sure. So they need to be able to build a team. So they need to have a track record where they've built teams in various other companies as well. And at the end of the day, so I live in Switzerland, and in Switzerland we have a saying that trust is broken. So at the end of the day, and as the first thing, you need to trust these people. And in terms of negatives, so I recently had a conversation with one startup founder, and I was looking at the website, and at the end of the website there is this year, copyright 2023, what we have today, and the year there was 2022. Then I went to his LinkedIn posts, and I saw that whatever his company is posting on LinkedIn, he's not actually liking them or sharing them, and so. Like one of my successful companies that we founded together with my brother. So the whole family, starting with my kids, we were involved with the firm. So you need to be passionate. You need to live with that firm on a daily basis. And in terms of negatives, so I mean it's reasonable to be realistic. It's reasonable not to overpromise. It's reasonable not to aim for, let's say, businesses where you don't have any experience, as an example. So maybe that's it.
Yeah, sure. So I think for us, we look at really two core components. One is people. So we always start there, and the other thing we look for is products. But I think specifically in this space, when you're talking about capital markets, infrastructure, like the hardcore stuff, very few people that don't have technical background can actually do that effectively. So for us, we look at, do the people have passion for what they're building? I think that's the starting point in anything you do in life. Do you do it for the right reasons? And I think a lot of people that are starting businesses, they read an entrepreneurial book and saying, okay, you just need to raise money, you need an idea, and then it's all flying. Very often it's the opposite. You are going to hit times when it's going to be really difficult, and you're thinking yourself, why am I taking myself and my family through this much pain to get here? You're constantly questioning yourself, should I be doing this? It's like you hear this party going on elsewhere, and where you are, it's quite quiet because it's quite tough. So to be able to get through that, I think you need to start with people that are starting business for the right reasons. And for us, the right reasons are you have a problem that you feel passionate about, you want to solve, and you want to solve it to, in essence, help the customer. And that's a genuine reason, and that's actually really difficult to find. People that are genuinely interested in solving problems, because most people are starting business, they're really interested in the money. And the realities are, when you're about to lose everything, the money really doesn't matter at that point, right? What matters is, have you done something that you really feel you're going to go all the way in, because you are going to have sacrifice. So we spend a lot of time on knowing the people we partner with. I think that's a really important part of it. Of course, looking at Guy, I mean, we knew each other for a long time before we partnered up, and there's a mutual trust. I think Guy is very passionate about his product. He's probably the best guy in the world for what he's doing. And that's really what we look for. We look for these people that have found their niche. They're really, really good at it. They go to bed dreaming about it. And when there is trouble, and there will be trouble, then they keep going because they're really passionate about solving these core problems. And of course, the opposite side of that is people that are looking at media and saying, I can be a millionaire in 12 months if I start a crypto business, or I can be a millionaire if I start an internet business. That's the easy route, and I think in this environment you flush a lot of that out, because this is a tough time, but it's also the right time to start a business. This is actually when you get a bit of more leeway. You're getting people who are true entrepreneurs, wants to do it for the right reasons. So yeah, that's really our view.
Yeah, it is true. I mean, they do say that necessity is the mother of invention, and it was during the 2008 recession that we actually saw the birth of fintech, which is now heading towards its Sweet 15 or Sweet 16. So it's a real rite of passage for the industry. But I actually, on the people side, Guy, as a founder, I want to flip this, being on the other side of the table, to you. What is something that you wish you knew when you were on your own journey of approaching investors?
Well, I think the entrepreneur's journey, or at least my journey, was the result of, I'd worked in large institutions. I was in banking before I set up my own thing. And what large institutions are very good at is teaching you to do one very narrow thing very well and very deeply. There's a whole bunch of other people that sit around you that do all the other things that require a company to function. And when you go out and set up something on your own, you need to learn all those other things. You need to learn finance and legal, and at some point HR and marketing and sales and coding in my case, and all these other things that you need to be able to do. And that's quite a lonely place to be to begin with, and it helps to surround yourself with good people. But another, particularly when the question obviously relating specifically to kind of funding and trying to raise money, you're going into meetings where you really have no experience of the fundraising experience and the fundraising process, and you're sat opposite people who understand the process absolutely backwards because they've seen tons and tons of fintech pitches, or they run a private equity firm, or whatever, or a VC, or whatever it might be. So you're going in very much innocent in regards to that process. And before the United Fintech deal, we tried to raise prior to that, and bizarrely we had the feedback that we were kind of the wrong size to meet any of the investments, because we were too big for seed capital, but we weren't big enough for Series A. And we're like, well, nobody told us what size we need to be before we even started to think about trying to do a raise. We just didn't fit the slots that these different investment companies had in terms of how they go about their business. It's just information we didn't have. So I would encourage anyone who isn't thinking about going out on this journey to learn as much as they can about the process, because when you do sit yourself opposite someone who really, really knows their stuff, they are clearly going to be more informed than you are.
Maybe I just add one thing there, that so if you are starting up today, if you're launching a startup today and you're looking for funding, then put in place like a list of 10 possible investors, and don't ever go to the best possible investor first. Take from the list really the bottom one, go there, because by the time you get in your mind to the best possible investor, you have already done the journey and you know the mistakes that you can avoid. So start kind of like backwards.
And I think I'd add as well, just to echo there, because I've spoken to a number of people within the business who are considering or have launched it, and do use your network. Like, speak to people who have gone down this journey around what are the trials and tribulations, what are the lessons learned, and also see if there are people who can experiment with. Like, I've been used as a pre-pitch, as a sort of can sense check the idea of the pitch. Like, what are the type of questions to ask from ex-colleagues as well. So do a lot of research. I think I can echo the comments here. It's not easy. but it can be very, very worthwhile. But go in with eyes open, definitely.
So it almost sounds like founders have to vet the potential investors as well and actually find the right match. But I also want to talk a little bit about how due diligence has changed. So in the current landscape that we're operating in, have any of your due diligence processes changed? And is there other factors that you're looking at these days that maybe you weren't 5 or 10 years ago?
I think there's more time to look at different investments these days. There's not the urgent I'm missing out on something. I think everybody's taking a fair amount of time. We've always been very customer focused on our due diligence, so I think that's one advice I would give in general when you're looking at business. If you're able to get the customers to verify what you're looking at in terms of both their long-term roadmap, does it fit into your strategy, does it fit into your roadmap? That is the best source of truth you can get, in my mind, is actually talk to not just the existing customers of the products, but actually people that you think could be using it. Getting early engagement with real customers. I think that's something we are certainly doing more of, is staying very close to that process. So I think we're not changed anything fundamentally in the DD process. I think we've always been quite diligent, but we are taking more time. I mean, the second deal we did in 2001, it took 45 days from start to close, and we are taking more time these days. So we don't have the same kind of urgency. We want to get it done quickly. We are more thinking, okay, have we ticked all the different boxes? And I think, again, the customer box is probably the most important one if you can get access to it.
I guess I mean, definitely the DD process takes more time now, and a little bit outside of this question is that what we are doing and what I see also many other firms who are investing into startups are doing is that they are maybe less eager in terms of investing into new startups, but rather maybe focusing on the existing portfolio, because highly likely, if not all, then most of these firms also require the additional funding. And as we are in the financial services space, then what I've seen really is that where we are focusing on is regulatory compliance. Because when you have these tough times, when the rates are at 5%, people are having tough times, then usually people are forced to relax, whether on the compliance side, on the cybersecurity side, their standards. And just to prove a point, so today I had a call in the morning with a potential startup, and what struck us was that, okay, when we met them last time, they said that the runway is 2 months. And now when we had the last conversation with them, they said that, okay, the runway is now 5 months. They have not received any additional funding. They have not fired any people. So the obvious choice for us was that they probably tapped into client funds, which is one of the solutions people use. I mean, it's obviously insane, but I mean, if you don't have any options and you know, you have to do what you have to do, and some people take that choice. And the other thing is that look at the team as well, that, you know, if the team is still there or if they are halfway already working with other projects. So another example that I have is that the team was still there, but you already see in like LinkedIn and other environments that they are already working with other projects. So essentially, you know, you are buying an empty ship. So you have to be really careful there.
And I think from our perspective, our due diligence is often dual track, because for over 80% of our investments, we're investing alongside some commercial discussions as well. So we're doing the investment due diligence, but also the product due diligence to join as a customer. And we think that gives us an edge both as an investor and a partner, because for an investor, we effectively have the customers in the building, and we can have an active dialogue to say, what are the weaknesses, what needs developing, and also not just how it would suit us, but also how it would suit our peer group or smaller banks or non-bank participants. And then also as a partner, because we can then, if we're an adopter of the product, we can then sort of accelerate their growth as well. So we see a lot of synergies there, and that fundamental synergy hasn't changed. I think, as we heard earlier, there's more focus on stress testing the business model and, okay, that's the plan A, but what is your cash burn? What's your plan B? And if your funding or growth doesn't come to fruition, what will you adapt and when? So there's more focus on that side, but fundamentally, we're looking for the same things in the company and how we want it to succeed as well.
So Guy, I actually saw you nodding your head, and again, as you were going through your own scaling journey and fundraising journey, what were some of either the biggest surprises or the biggest challenges that you found in terms of running those operations or maintaining a low burn rate?
Well, just to kind of adds to what the comments just been made, I mean, when we went through our DD process with Christian and the team, I'd advise any organisation who's looking to raise money and is going through a DD process, particularly if you're technology-driven, which obviously these firms are, you've got to make sure that your infrastructure and your technology is secure. You can never start thinking about that early enough. You can't think, oh, we'll build a product and we'll worry about security 2 years in or whatever it is when we can hire enough people. You've got to think about it from day one. Not least because if you do want to sell your product to large organizations, they're going to be far more stringent on the technical due diligence side of things than an investor would, and you just won't get through the door. So we started thinking about very, very early in the process, and it was actually one of the best bits of the conversation with the team at United Fintech, because we basically had ticked every box, before, so there were no things that needed to be looked at. So I would absolutely advise anyone going through this process to think very, very carefully about it. It's not that difficult these days. People think it's super complicated. The resources that are on hand to help you do that these days are very readily available, and it's not difficult to implement some very, very secure practices from a very early stage.
And I'll second that. In terms of onboarding, information security, cloud architecture review, with good reason, are two of the most sort of scrutinized components of the onboarding process and can take the longest. So the more that is already thought about, done and dusted, everything's a tick box, makes it a lot smoother process.
Well, since we are talking about a very tech-forward industry, I think we would be remiss if we did not actually touch upon some of the opportunities in transformational technology that founders are working on, particularly in the turning point of an environment that we're operating in. If FinTech fundamentally stands for a transformation of the financial services industry, which areas within financial services are most in need of that transformation? And what problems or pain points should entrepreneurs be solving for?
I can answer that from my perspective at least. We look at it like, FinTech for the past 10 years has been mainly B2C. That's been the front end of people's mind. That's a big success story you all read about, whether that's Revolut or Klarna or all these other big FinTech successes. And a lot of these FinTechs are based on, I would say, front-end digital paint. It's not actually infrastructure. A lot of these companies are using the same old infrastructure that's been in place for many, many years. So this has been the current focus. What I think is interesting and what we are focusing on, of course, is the core infrastructure for financial services for the next 20, 30 years. And that space is still in an infancy. The infrastructure across banking, across asset management is still very legacy. It's very much like 80% of money being spent in that space is keeping up and maintaining old systems. So we think there's an enormous opportunity in kind of helping financial institutions innovate and get access to new infrastructure in that space. The obvious answer to your question is, of course, a year ago it would be blockchain or digital assets. Now it's AI. So you're always going to have these things that pop up, and the whole world is watching and going into one direction. But I think from our perspective, we take a long-term view on it. And there's definitely AI conversations that's interesting, but stuff like AI we see as a quite major jump for, let's say, a bank to take a process where they are today and just implement AI on it. We think it's more bolt-on to existing workflows. So I would say we more use existing technology, and again, now sitting next to Guy, he has an existing technology platform and adding AI on top of that, as opposed to turn into an AI company. So for us, I think the long-term trends we see is on the B2B side. That's interesting, the infrastructure side, and that's a very broad answer to your question, but I think that's where we see excitement. Of course, we go into different areas, like we think data is interesting, we think front office technology is interesting, we think future-proofing technology is interesting, but really the commonality is over the next 20, 30 years, all financial institutions need to get rid of the legacy technology, and that's in itself super exciting, I think.
Yeah, I mean, it's funny that you mentioned AI actually, because even just this morning I was having a conversation about how a number of fintechs have been rebranding their websites to end in, instead of moving away from .com to .ai. And if you're trying to bill yourself as an AI company, when you fundamentally offer another product, it kind of brings up the question of your brand's integrity, right? And it can also be, you know, it brings up the question of whether or not AI is overblown, but also where is it useful? Where does it delight the customer on whether it's B2B or B2C?
I mean,
level,
I would
right?
just comment on AI these days. I mean, we are not looking specifically at AI companies right now, and I think that's not us being, you know, old-fashioned. But I think what we hear from other people is it's very, very difficult right now to figure out what is actually true, you know, technical engineering-based AI, meaning they've coded their own models, and what is based on someone else's AI model. And so it's almost like the crypto space a couple of years ago. It's so difficult to fill out for our purpose who is the true engineers here and who is using other people's stuff. So you can very quickly get into a situation where you're investing into something that looks like AI, but in fact it's based on someone else AI, and then, you know, you're overpaying massively for that.
Yeah, so if it looks like AI and it talks like AI, it might be something completely useless. Ingmar and Andrew, I want to turn it over to you as well.
Absolutely, yeah. So I was at the Web Summit last week in Portugal, and so when last couple of years you went there, and everybody was talking about blockchain and crypto and NFTs and so forth. And now, so last week, so half of the startups had like a focus on AI. But before I get to that, then again, like going maybe a little bit backwards, then oftentimes people are focused on doing something super innovative that is not maybe there, and so they're trying to come up with something that maybe doesn't exist, you know. But sometimes it just makes sense to look at an industry, for example, that is old, that is not popular, that has not been seen much development. And I can give him from our side like an example. So at Tickmill, so we launched futures and options a couple of years ago. And we walked into that industry because nobody cared about this industry. In the US, so the firms were not investing into futures businesses. The websites were like 20 years old and so forth. So sometimes you don't really need to figure out something super innovative, but you just need to enter a space where there are just dinosaurs there, and you know, it's just easier to compete with them. But in terms of the latest developments, then I think with this polarizing world where we live now, and probably the world is going to polarize even further with this latest geopolitical developments, then what really surprised me last week was that there are so many firms focused on payments, because people are now like scattered around the world. You have developers in 50 different countries all work for you, and you need to make payments to them in terms of their monthly salaries. So many firms are focusing on payments. SMEs, for example, so SME credit, because I mean, if you walk to a big bank, they definitely don't want to work with small companies. And definitely, so AI. So I mean, I was even like prepping my answers for today, and I used AI yesterday, so ChatGPT a little bit, like, and I use it quite actively. So and I think it's definitely a space where one needs to be focused. Maybe not like investing today, because it's just really uncharted territory, but just keep an eye because probably some of the next unicorns will be in that space, really.
Andrew?
And I think from my perspective, I mean, the positive message is we see opportunities are investing in fintech companies across the spectrum. So whichever asset class, all of our trading businesses, equities, FX, fixed income, commodities, across our payments business, custody, fund admin, there's opportunities everywhere. I think there are a few common themes. There are some areas that are still very manual. If I look at syndicated loan market, it's still using the fax machine. In a lot of the credit business, it's still using paper. So there's I mean, to Ingmar's point about technology doesn't have to be particularly sophisticated to be transformational for an industry. That's very much true. There are also a lot of industries that are still on technology that's 10, 20 years old or more. We invested in a couple of transfer agency companies for fund administration. And the impact that that can have on the end user will be transformational. What it's doing, when you sort of put it on a PowerPoint, it doesn't look as though it's going to save the world, but there can be some very big, very successful franchises. But it requires a mix of someone who can see that opportunity, understands the market enough, and can bridge the technology through to product, through to customer base, to push that through. So I think it's a very fertile ground out there. I think I'd echo some of the comments. Be wary of getting caught up on the hype wave, whether it's blockchain a few years ago or now with AI. Definitely agree with Christian. We're seeing it as a potentially a massive enabler for a lot of product solutions, and we're seeing that in our portfolio companies as well as pipeline. But in the sort of core AI, and we've been public around this, we're doing a lot of experimentation. We have like a few hundred people with access to it, aiming to give like tens of thousands of our coders access to it next year, but still going through the process of, like, as a bank, how do we use this? What do we do internally? What do we do externally? And then what are we looking for external solutions? But I think looking across our portfolio, like the generative AI capabilities, for a lot of them, it's an opportunity, and for even more, it's a potential threat if they don't get it right. And we're viewing that as our sort of window into that innovation as well.
Well, thank you. So I know we are running short on time, but I always like to end my panels with a little bit of a forward or crystal ball gazing or practical advice for the audience to take away. So I'm quite certain that we might have a few founders or future founders in the room with us today. And I want to end on a little bit of practical advice. So for anyone who either has recently taken the plunge or is looking to start their own venture soon, very quickly, any practical advice?
Firstly, definitely do it. It's been the most rewarding experience of my life. I would not advise people to do it if their sole goal is to get rich. It's not about the end, it's about the journey. It is the journey of building a business from, seeing it growing from, a seed to something that's actually starting to thrive, building a team, leading a team, all those things. That is the thing that makes it all worthwhile. If you can get rich to boot, absolutely fantastic, but I would highly advise people not just to get involved simply because they think there's a pot of gold at the end of the rainbow. As Christian said, it is incredibly hard work. It takes far longer than you ever think it would. And it's a little bit like having children. If you knew what it was like before you did it, you probably wouldn't do it in the first place. But I'd also advise people, as Andrew said, to really utilize your network because they can be sources of advice, counsel, leads. They can help you build your business.
Christian?
Yeah, I mean, I talked about it already, and I think starting for the right reasons is probably the most important thing, that you have core passion for it. But adding to that, I agree with Guy's comment that this is a long-term journey. Entrepreneurship is really something of a calling that you do and you live and you become. It's not something that you do for 2 years and think, okay, I'm going to give it a shot. Of course, that could be an option you're forced into, but I think it takes a lot of grit and a lot of resilience and a lot of mindset to get it right. But then I think it's also truly rewarding to take something that is not there, think about it, talk to people about it, make it happen. And with that, again, if I'm leaving to one piece of advice outside what I already said, I think it's make sure you're doing it for the long haul, because it will take a lot longer than you think. Everything will take longer. And yeah, that's always surprising people. I'm quite optimistic myself, and everything takes longer.
Yeah, so you'd better enjoy the journey then, Ingmar.
Like my message to those who are looking to launch a startup is that start today, because if you start today and the idea is not valid, you will fail fast. So you can get another idea, And definitely what I've learned from my own journey is that you really need to be 200% involved. So, like, for example, I don't like pitches whereby, let's say, the founders are still working somewhere. So it's definitely like not a huge focus for them. So they still work for some other firm, you know, and that's kind of the part-time the startup that they are trying to launch. And so when we launched Tickmill, for example, with my brother, then we knew that we have to make it work within 12 months. So every day, every night, every weekend went towards building the product, the firm, and to a firm that is funding other startups as well. So as a founder, all you have is your experience, your effort, your time. So if you're not even willing to invest your own time, like full time, into the project, then nobody really cares. So you just end up sitting there and thinking about what you could do and so forth. And the other thing is focus on the customer, focus on getting to the market as quickly as possible. And an example to you, so we were about to invest into one firm. We were willing to be the only investor, actually, so go in really big. And there were delays because the tech guys were focused on the back end. So the tech guys were focused on having a throughput of 100,000 orders per second. So if you don't have a single client, you don't have a single order going through the system, you do not need to focus on your system, you know, what they need to be 3 years from now. You need to go and get the product out and see whether there's appetite, you know. And one thing to conclude from my own experience as well is that we talk about startups, we talk about work, like probably the most important thing is actually your health. Because if you forget doing sports, keeping a good lifestyle and so forth, then ultimately, yes, you might succeed in building a good, successful startup, but what is then left from you is another question.
All right. And Andrew.
Okay, I realize we're over time, so I'll be quick. Just one part is be very clear on what problem you're solving and for whom, so reiterating the customer point. And I think, secondly, I'd echo the doing it for the right reasons by introducing another red flag. The founders who are overly focused on valuation rather than building a sustainable, good franchise for which valuation is an output. And we've seen too many where, oh, it's my startup's definitely worth 50 million and there's no way I could accept 45 for it. It's like, that's a distraction. Focus on the long-term game, build the company, build the business, and success and valuation will be the output.
All right, excellent. Well, I just wanted to say thank you to all of our panelists for giving some really practical advice. I think there's some fantastic takeaways which fundamentally rest on focusing on your customer and not overthinking a problem when solving some very complex issues. All right, I think we've just run out of time for a Q&A, so hopefully everyone can stick around and maybe answer a few questions personally. But once again, thank you to our panel and thank you to everyone for joining us.